Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hey Marc, welcome back to the Australian Investors Podcast.
Thanks for having me, Owen. Boy, great. Always great to be back.
It's always good chatting to you, mate. We just have a lot of fun doing this. We get to talk about something we're both really passionate about, which is investing, specifically ETF investing. Today we're going to have a bit of fun with a couple of these questions. We're going to talk about Peter Lynch, the famed one-up on Wall Street author and investor. I'm going to try and blend in a little bit of Warren Buffett, which we're just talking about. And we're going to talk about how ETFs are constructed, this idea of growth at a reasonable price, or GARP, as we call it. There's been ads running on the podcast lately. And then there's some other charts that you shared recently, which are more like how the stock market produces returns for investors, which I want to kind of lift the lid on. So my first question is a very different one. I've never asked anything like this, and it was kind of like a setup. It was a bit of a imagination caps on, please. And it was, if you had like a ray gun, obviously ray gun being really popular at the moment, if you had a ray gun and you could point it at any investor and they would instantly become 18 years old, and you pointed it at Warren Buffett and Peter Lynch, two of the greatest investors of all time, and bang, they are 18 again. Now I want you to imagine that you have $1 million, right, Marc? You got $1 million Marc dollars, and you've got two of the world's greatest investors in history standing in front of you at 18 years of age. You know their pedigree, but you don't know how they're going to perform over the next 20 years. So my question is, if you got a younger Warren Buffett and a younger Peter Lynch today, and you had them side by side, but you could only invest in one of them and their career or their fund or whatever they're about to create, who would you go with?
This is a great question, and one I don't think I've ever been asked before, Owen. So it's very creative. It's almost, I use it a bit analogous to, if you go back and compare it to major sporting stars, LeBron versus Michael Jordan, who's better, Ronaldo versus Messi. I mean, we're talking about two titans here when it comes to investing. And when you compare both of their strategies, and we'll go into, I guess, the differences between them, Lynch did outperform Buffett over the period that they were both managing money. I guess they both have very different investing styles, or not too dissimilar, actually. Buffett was more focused on, buying undervalued companies, strong competitive advantages, a bit more of a value investor, incorporated a margin of safety. And I love the quote that he always used, which was, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And I guess Lynch is also kind of a disciple where he's a hybrid between growth and value investing. They both argue, stick within your circle of competence, very important. I think the difference is Buffett took a bit more concentration when it came to his bets, whereas Lynch was a bit more diversified in his approach. But like I said, Lynch was a bit more active in nature. That probably led to a little bit of burnout, which is why, while he did manage the Fidelity Magellan Fund and achieved exceptional returns, he couldn't last for that long, whereas Buffett has just been going on for decades and decades and decades. So I think in their prime, I'd probably say Lynch, to be honest, using a GARP investing strategy. Lynch also wasn't a huge fan of index funds, though, and that's where I'm kind of gravitating towards Buffett, because he loves index funds and he's got that long-term tenure. So 18 years old in their prime, you're hungry, full of testosterone, probably Lynch in terms of stock picking capabilities and using this GARP approach, which is what we're going to discuss later. But that tenure and having this durability, Buffett is still up there as one of the greatest.
Yeah, that's why I thought 20 years was the interesting kind of horizon to give you, because that's kind of the duration that Lynch was probably the greatest investor in the world for. If you just measure like absolute returns over that period of time. But Buffett is obviously, as you mentioned, like so unique in that some great investors get to 10 years, some get to 15, maybe some get to 20, but I don't know any others really that are in public market view for over 50 years. Like, that is unbelievable. And I got to admit, I didn't really think that what you said, he did outperform Buffett in that time. He was much more active, equally like educational is probably fair to say too. Wrote the books. really good analogies, anecdotes, and examples for every investor to follow. It's interesting, too, that he was more active in nature. He was more active, very much more active, but
he was. But there was
special.
a lot of crossover. I think Buffett actually quoted Lynch in one of his investor letters, which I recommend any investor to read. Is Buffett's letters to shareholders. A fantastic golden nuggets in there. So there was a lot of crossover between them. But I think Buffett said it was the most powerful force in the world is compound growth, and you just want to do it for an interrupted period of time. And that's what Buffett has been able to do.
So my other question, which we joked about off air, was you're like the guy, you understand ETFs, you research ETFs, you're around ETFs. The key thing is you also create ETFs, like you help design them for Australian investors. And I'm curious, why don't we have a Buffett ETF? Why don't we have some sort of ETF that some roundabout way is kind of like Buffett? I'm sure someone would buy that ETF.
I'll add that to our next product development committee, Owen, as a suggestion. But it is a good question because a lot of people want to invest like Buffett. So why not just invest a Buffett ETF? My, I guess, counter argument to that was just buy Berkshire Hathaway, publicly listed company that pretty much holds the companies that Buffett invests in. I know the Class A shares are incredibly expensive. I think they're at $600,000 a share to buy, but there is another share class that you can buy, which I think is about $450 or $500 a share. But there have been ETFs that try to mimic the style that Buffett tries to incorporate, whether you're looking at things like competitive advantages, valuations, value-orientated strategies with the focus on income. Like we've got our ZYAU ETF, which we've spoken about before. Interestingly, there is a lot of innovation in the ETF space, and something that I'm very excited about is coming out with new products. I guess we have to think about the durability of products as well. So, for example, there is an ETF in the US that's actually recently come out where it actually uses AI to build a global equity portfolio using the minds of Warren Buffett, Stanley Druckenmiller, David Tepper, and a lot of others to try and kind of incorporate that. We'll see if that gets any traction. Our US team as well, we've got an ETF over there called Guru, which looks at hedge funds. It looks at the pool of hedge funds that are in there. And there's been a lot of different derivations of ETFs. There was a Cramer ETF, which looked after Jim Cramer's Mad Money predictions. There's one that even follows Nancy Pelosi and looks at the political parties. But I guess whilst, a lot of these are interesting ETF ideas, there has to be practicality to also adding it into portfolios. Where does it fit in your overall asset allocation? And probably that's why something like a Buffett ETF doesn't exist, is you want that durability and you want the factors or the styles, which we'll get into in a little bit. But I will definitely add it to our next product meeting and we'll see if that resonates.
So I got to admit, the reason why I asked those two questions is it's interesting how the mind works. Someone can plant the seed and then you just you go off in different directions. And those first two questions came because I was reading your write-up on the GARP ETF that you've just launched at Global X. And you mentioned Peter Lynch in there. I was like, I wonder if I was good enough to be like Peter Lynch, would that be good enough to beat Buffett kind of thing? And that's what I was thinking. And I was like, a lot of those companies that Buffett owns, you could probably, it'd probably be harder to put in an ETF than say what Lynch owns. And that's what we're going to talk about today, which is the GARP ETF. So GARP. Let's unpack that acronym for folks that aren't familiar. I mean, I've been around it for a long time, but can you start with what it is, and then we'll start to build it throughout the show?
Definitely, Owen. So GARP is an acronym. Like you said, we love our acronyms here. ETFs, FANG, GARP, it's all what it's about. And it stands for growth at a reasonable price, like you mentioned before. Now, the first thing to note, Owen, is that even though this is a new ETF that has come to market, this is a proven investment strategy that has been around for decades. We talked about Peter Lynch, who popularized it, during the 1980s. He managed the Fidelity Magellan Fund, and like we said, it was one of the best funds in the world. It was actually the best performing fund over his tenure. And really, it's about combining a range of different factors that a lot of investors might be familiar with, such as growth and value, and having a bit of a nice intersection between the two. And I think a lot of people are worried that, do I want to be on one side of the pendulum or the other side of the pendulum, growth or value? And as we've seen, they can go through different regimes and go through different periods of outperformance. So when we looked at bringing this out to market, we thought, well, what is an interesting way that people can access growth stocks? But where with markets at all-time highs globally, people might want to have a bit more of a value discipline or don't overpay for growth. And that's where you can take, a basket of stocks. And I'm happy to dive into the methodology if you want me to go down it, Owen. But you wanted to take a basket of stocks that is growth focused, but also apply a valuation discipline to make sure that you're not overpaying for these stocks. So that's why that's in essence what a GARP strategy is.
Yeah, so it's kind of like, just making sure you're not doubling down on those things that have really ran hard, whether it's momentum, whether it's whatever. Many people may be familiar with Peter Lynch's idea of like a PEG ratio, price earnings growth. You basically just take the P ratio divided by the expected growth rate. And it's really useful, and a lot of investors, even professional investors, use similar types of strategies. There was a good post in our community by Scooter who did reference an AFR article. And this is because this is a strategy, as you said, that's been going on for a long time. Maybe just a quick question on this, like when you put these ETFs together, obviously this is the first time it's been in Australia, but do you have to do a lot of back testing? Do you have to look at a lot of like data and pull things together that way to make sure it's proven and it works? Like does that make sense?
Yeah, 100%, Owen. And it comes down to when you're building a product, you want to find a product that has investor appeal. Obviously, having a nice back test is important, but we ran a lot of derivations with S&P, the index provider, on constructing an index like this that would be appropriate for the Australian market, because there hasn't been an Australian index that has that GARP methodology. There are some active managers who do that in the space. But we took the existing framework that has existed in the US that tracks the S&P 500, and we wanted to bring it to an Australian landscape that looks not just at the S&P 500, but that looks at global stocks. Because whilst America constitutes about 70% of GARP's current index, who's to say that that'll continue over the next 10 to 20 years? It wasn't like that 10, 15 years ago. So to answer your question, a lot of thought goes into it. We think about how would be packaged in terms of actually trading the underlying securities, the liquidity, the currency. And yes, if it has a nice back test, that's just a bonus. But I've always said that, just because it has a good back test doesn't mean you should invest in it. And even though GARP does look really attractive when you look at it historically, since, it's got a 20-year history now, it's more just the application fit for a client's portfolio. And I think now, given markets are at all-time highs, people are a little bit worried about valuations, but they don't want to be invested in cash. They know that they want to be in the upside of equity, because we know that all-time highs generally leads to more all-time highs. They generally clustered around the same period. So it was a lot about the application. But yeah, we did a ton of work, Owen, around the analytics behind it, the methodology behind it. Can this work to bring a product out like this?
And that's probably where I want to go next. But I was just thinking about it. So GARP stands for growth at a reasonable price. The first thing I like to do when I look at these unique ETFs is I look at the price of the ETF or the fees. It's actually, I was just thinking, maybe the headline of this podcast could be GARP at a reasonable price, because the ETF itself is 30 basis points or 0.3% per annum. Because I use that as like a yardstick of can I afford to put it in my core portfolios if I have a bucket that, and a constraint around how much goes in there in terms of fees and whatever. But it's similar to FANG and a couple of the other ETFs where it's like reasonable and it can go. I would say just what I know so far is it could go either as like a strategic tilt on a portfolio, or it could go in the core. And that makes it really interesting. But Marc, when we talk about, like you mentioned before, like high growth without the price tag and these types of things, quality is obviously a part of this ETF too. I'm hoping you can really pull apart those factors which go into the ETF, and then I can, for anyone that's watching, I can show a table and we can walk people through basically what the end result is. But what are those factors that actually go into constructing this ETF?
Great question, Owen. And the beautiful thing about an ETF tracking an index is it's all transparent, and you can see the methodology on our webpage. There's a little page, a little file there that says index methodology that gives a summary of it. So that's a great thing about using index funds or ETFs for something like this. So I'll go through very high level, and we can double click on anything that you want. And like you said, refer to any charts or tables. But pretty much it takes the broad investment universe, excluding countries like Australia, which, you're talking about thousands of stocks, and it finds the top 500 companies that have grown both their top line, so their revenue or their sales, and also their bottom line, so their earnings per share, or EPS is what the another acronym that we mentioned before. So that is in essence what the growth factor is. But as you said, Owen, before, is we wanted to have a product that maybe packages a few different factors into one. And you can invest in a pure, simple growth ETF, but again, it's trading at a very high valuation, and people might not want to pay for that. So then we decided to incorporate two other factors. Quality is quite a known factor, particularly here in Australia. It's a proven factor that drives performance, and using things like profitability, leverage, return on equity. These are common things for identifying growth companies, as we've seen from a lot of active managers themselves. I mean, both Buffett and Lynch were both proponents of investing in quality businesses. And then from there, so you've got the growth factor, the quality factor, and then the all-important value factor is the last screening process it goes through. And that looks at the price to earnings ratio of a particular company. So how much money are you willing to pay for $1 of earnings? And when you combine those factors together, you then get a nice top 250 companies that then gets weighted by its growth score and its market cap score together. The thing I do like about this product, Owen, is we've talked about concentration and how Buffett was big on concentration. This portfolio limits each individual stock to 5% as the max cap. And also you can't have a sector cap more than 40%. So it can't have technology at 60, 70%. So that's a little bit about how the index is constructed. And, we felt that 250 was a nice, not too concentrated, but pretty diverse enough across a range of different countries that still looks, pretty attractive, but it does have, strong earnings growth, solid financials, solid financial strength as well, that still trades at a pretty attractive price overall.
I find it neat. I don't know if you do this with every ETF you guys bring out, but I did notice this on the site when I was reading the marketing literature and the white papers and that sort of stuff. For folks that aren't watching, I'll just walk you through it, but we're comparing it to the world index, the S&P World Index ex Australia versus the GARP index, so the one that the ETF tracks. There were some things in here which were quite interesting. For example, like net profit margins, which is probably where the quality kicks in. 22% for GARP versus 17.7% for the world index. Still pretty high, to be honest. That's still pretty high. Earnings growth over 3 years, 52% for the GARP index versus 24% for the world index. Both still pretty high, but obviously we're cycling out of COVID and those types of things, which help. ROE, 32% rounded versus 24%. And the PE ratio, which is probably that reasonable price metric, 18.6 versus 22. I think a reason that this has really caught on in our community is because of the valuation component mixed with the quality, because a lot of people think that quality alone is not good enough to kind of create the outcomes that they want, particularly with like a 3 to 5 year view. I don't know if this is fair in terms of what you expect from like a drawdown perspective. Like, would you envisage that on a drawdown, so in a down market, this doesn't fall as much as like a S&P 500 or a global, like all world index? Is that?
Yeah, it's a good question. So on your point around the drawdowns first, it does have relatively similar drawdowns because it still has that growth tilt. And naturally, a lot of growth companies, if they do have like earnings compression or they do normally get hit because they are higher beta play, they generally fall a little bit more than the market. Value on itself is probably a little bit more of a defensive strategy. Same with quality as a whole. But the great thing about GARP strategy is that the recovery period, once it hits that drawdown, is a lot quicker than some other strategies. And that's because coming out of, I guess, this economic cycle where you have your growth phase and you've got your slowdown and then your recession, in that recovery phase, you want to be owning the companies and no one knows what the sectors are going to be that's going to be driving that recovery. So by owning the sectors who have strong earnings growth around that time, that's what leads to GARP recovering a lot sooner than other strategies. But from a drawdown and volatility perspective, it's not going to provide that defensive cushion as much as other sectors. But overall, like you said, those metrics are very compelling because at the end of the day, as investors, we want to invest in quality companies that are growing their earnings and all importantly, we don't want to be paying too much for them. And right now, Australia is trading at 21 times earnings, the US at 26, the world at 24, I think we saw before. GARP's at about 18 times earnings. And naturally what happens is there's been a few periods where markets have looked quite toppy, and it's not a reason to not invest. As I mentioned before, investing when markets are high is usually a good recipe in terms of future returns as well. But overall, when you're looking at, you have to have a value discipline when it comes to something like this. And I think that's where GARP does have its merit around that. Still got really quality metrics. It's not totally value orientated because a lot of value stocks don't have that same growth profile or those earnings growth. And that's what drives a lot of the share market returns. So overall, it's a nice blended mix that could provide a core offering in client portfolios.
It's I'm just going to bring up another screenshot here. Normally when most people familiarize themselves with global equities, global shares, they're investing in ETFs that are market cap weighted and traditionally weighted like that, and not really realizing that sure they could go equal weight or sure they could go this to change the mix of the portfolio that they're building, but they could also use factors to do that in a more more professional way, in that you can see the stocks here and on the screen in front of you. If you're listening, it's Tesla, Apple, Nvidia, Meta, Microsoft. So similar names that you would see in some of like the S&P 500 or something like that. But interestingly, it's the weightings which are very, very different. And then how they, like you said before, they're capped. So eventually if they grow, they pop out. And I thought that was really interesting. But there was one chart, Marc, which you had in a write-up that I'm going to try and find this right now and walk people through what I'm looking at. Or what we're looking at. So it works on audio. But you shared this chart, which is on the screen in front of me. It comes from Bloomberg Data and Schiller, Professor Schiller, that is. The S&P 500 index total return, and you show the components of the return. And this is something we try and talk about a bit. Basically, this chart shows in 3 columns, 1-year returns, 10-year returns, and 20-year returns. What component, like how much of that return that you get from the market overall, the S&P 500, comes from those various things being earnings, like profit growth, the multiple expansion, so profit, like the PE ratios squeezing or extending, and dividends. Now, I'm just going to call out something which I thought was really interesting. Something that we kind of know is that from context that Australian investors tend to get better yield. When I see this 10-year chart, right, it shows that approximately, just eyeballing it, 15% of the return comes from dividends. That's the first thing that really stood out to me, is how much lower that is versus the Australian market. I'm curious, was there anything else that jumped out to you when you were doing this research?
That for me was one of definitely the key takeouts, Owen, is that in Australia, over 50% of that return is generated from dividends here in Australia over that long period of time. So for those who are watching online, that light blue bar in Australia looks a hell of a lot different than it does to a world ETF like this. But the other thing that stood out to me, and I think I mentioned it in the previous podcast that we did when we talked about property versus ETF investing for retirement, was that how powerful earnings growth is. And whilst valuations may impact short-term returns, it's really about earnings growth, which is the orange bar on your screen, which does contributes the most to long-term returns. And that's because in the short term, market returns can be influenced by a range of different psychological factors, emotional factors, greed, fear. But over the long term, generally share prices follow the trajectory in earnings. And that's why as investors, we want to invest in companies that are growing their profitability, growing their cash flows, growing their earnings over time, because that is what drives the majority of the share market return. Whereas the multiple expansion, or what that, re-rate within their PE ratios, what you're willing to pay for a company, doesn't matter as much in the long term. So I say those are the 2 key takeouts for me, is just how reliant in Australia we are on dividends versus the world. So that's why you need some growth in your portfolio. But then secondly is around the benefit or the long-term correlation of earnings growth leading to share market returns.
Because I see variations of this chart. Like I've seen it on a security basis. So like people can cut this up and they can show it on like the 10 best stocks, what drove their results, or like the worst 10 in the ASX 200. Like you can do all types of, mental gymnastics and spreadsheet gymnastics at the same time. But with this, I find it very powerful to see that if you are a long-term investor, you have to be focusing on the companies that generate profit growth. not necessarily just quote unquote cheap stocks, but if you can blend them together, you can get a pretty smooth return. You can get a pretty wicked return over time. I've got a couple more questions here, Marc, for you. Do you think something like this would work well in Australia? Like this has got 250 stocks, if I'm not mistaken. So it's more global, reasonable fee, pretty highly liquid companies that are inside it. Is there scope to have something similar to this in Australia? Is the market too small?
We did look at it, Owen, and for us, it was about a lot of the money in especially ETF land over here is going towards global equities. We also wanted to have a broad global equity offering, which is why we wanted to start with this. But we did consider the Australian landscape or the Australian GARP strategy as well. It's a little bit different in Australia though, because like you mentioned, we're predominantly a value-orientated economy. Whether it's the banks, the miners, like I said, dividends and income is a huge focus, which a dividend like GARP, you're not going to get as much. It's like less than 2%. So it's a little bit different. That being said, there are ways to play Australia. The difference with investing solely in Australia is there's not a lot of growth here in Australia. And I don't mean to sound pessimistic, but that is the simple fact that a lot of if you look at, some of the big banks, the miners have actually done all right in terms of the recent rise in commodity prices. But the banks don't grow their top line and bottom line revenue by double-digit numbers. It just doesn't happen. So to have an ETF that excludes banks, as an example, which is one would be a huge factor, they also do have leverage as well, even though they do have a lot of the capital ratios are some of the highest in the world. So sometimes when you're looking at the different other factors, whether it be quality, a lot of it may be screened out as well. But it'd be quite interesting to have a broad Australian offering that doesn't include banks. And we do have a product out there, OZXX, which does include banks and resources, which people can use. But GARP is definitely an interesting idea that we, did think about bringing to the Aussie market. But for us, because there was no low-cost index tracking growth stocks in the Australian market, looking at global equities, we thought this would be appropriate. There are some active funds, like I mentioned, but you mentioned, Owen, before, charging 0.30% or $3 for every $1,000 invested is a pretty attractive value proposition versus some active managers who are doing this, not a new strategy, but are charging a lot more in fees. And to save people the hassle from rotating out of global stocks, monitoring sectors, which company is going to be driving the earnings growth, doing it in a low-cost ETF from a global landscape made sense, but there still is scope to potentially look at how we can apply this to other regions like Australia.
It's I think that's why a lot of the feedback that I'm getting from our community on the GARP ETF is more, I would say, people in or approaching retirement, because they're looking at markets thinking, how can I still want to be exposed to these, but I kind of want to control that a little bit more. You talk about this a lot, and it's obviously in the PDS as well, which people should read before they invest in, etc. But in terms of I'm trying to educate more people, Marc, on the show to understand how factors and the actual methodologies change the outcomes for people. Even if it's not the absolute outcome, like the journey to get there maybe is different. So if you were thinking like high level about risks, you already mentioned one, which is kind of like, well, it does invest in growth stocks, so it may have a drawdown. But are there any others that spring to mind that people should be aware of?
Yeah, I think it's important to note that this is not a pure growth or a pure value strategy. That's the first and foremost, Owen. You mentioned that, during a market drawdown, this will probably have relatively similar drawdowns. Not saying it's going to have more or less. The historical back test says sometimes it's less, sometimes it's a little bit more, but overall not too excessive. So generally, value stocks provide a bit more defensiveness during those market drawdowns. A product like this as well definitely has a little bit more volatility than a traditional index. But the difference with a product like this, if you look historically speaking, it has had better returns. So when you look at it on a per unit of risk measurement or your risk-adjusted returns, it is actually over the last 5 years done better than all other factors as a single silo. So, when you think about what's the riskiest factor, you're probably looking at size, like small caps, or purely growth. And then when you're looking at factors that have the least risk, you're looking at like min volatility, value, even quality kind of sits around there. Whereas this product kind of sits nice bang in the middle, and it actually has the best risk-adjusted returns over the last 5 years of all of them. So I think that's something that investors should note, is that you probably could expect to see a higher volatility profile with something like this. So it won't protect as much during the downside, but especially during market recoveries, that's where it does quite well, and you're still getting exposure to growth companies overall. So I don't want your retiree clients thinking, this is a value ETF, it's going to provide an income. You have to be able to weather that storm if there is a little bit of volatility. But I always say that, volatility is the price of admission that you pay for investing in the share market. Otherwise, you should just be in cash or something like that. So there are a few risks of investing with GARP, but because it's kind of been seen as to withstand multiple economic cycles and can be a kind of buy and hold play that you can hold over the long term, it definitely makes an interesting value proposition to put as part of a global equity sleeve for clients.
Yeah, I think that's what I was getting at too, is that I would imagine that you mentioned it as part of, not a replacement. And I think that's really important too, because I could see it complementing and blending well with like S&P 500 or World, whatever. But I actually had a fun question that as we come towards the back end of the show, which is, as you know, like we were just talking off air about how successful the FANG Plus ETF has been for Global X. It's been like, and probably neither of us fully expected it to be this successful, but it's been super successful for you guys and just for investors. Like my co-host on the Investors Podcast, Drew Meredith, has proudly owned it for a very long time, and I think he still owns it, so he's very happy. But that ETF in particular, that's like a concentrated exposure on the best, it's fair to say the best companies in the world. You got like the big tech companies growing fast, good profit margins, good cash on their balance sheet, that sort of thing. And this is in a similar type of vein, but in quite a different way. It's like, that's how I would imagine people using something like this. If I was to ask you, and this is strictly hypothetical, it's not a recommendation, I just wanted to tease out and have a bit of fun. If you were to juxtapose these two ETFs, you put them side by side, and you had a 10-year view, relatively, I guess, which one would you pick? Like if we just think about performance, not volatility, or unless you want to think about it like that, that's totally fine too. Just how would you go about making the decision of either or just both? Or
yeah, I love these hypothetical questions, Owen. Really, does make me think a little bit about but my own investment portfolio. I think it really comes, do you have conviction that these mega cap tech stocks will continue to grow and continue to grow their earnings as they have done for the last few years? Or are we going to start to see a bit of a broadening out in the share market? And will we see other players drive some of the share market returns? Because if you think about it, most of the share market returns are driven by about 4 to 6% of companies. So concentration shouldn't be seen as a bug. It's a feature of pretty much products. It doesn't necessarily mean it's a bad thing. But if I want to get a bit more diversification, particularly over the next 10 years, I do think that mega cap tech can continue to grow. And you mentioned that these are some of the best capitalist machines that we've seen in the world. But I don't know if tech is going to be always doing the heavy lifting. And that's where a product like GARP, which has at the moment about 30% in tech, the sectors can change over time. So FANG does have a bit more, to your point, volatility than GARP because it's only 10 stocks. GARP is 250. But when you actually compare the risk-adjusted returns, which is something we spoke about, they are almost identical. So I don't think you can actually go wrong with either. And we're seeing a lot of clients actually blend the two together, because there is a little bit of an overlap. About 7 out of the 10 holdings in FANG is currently in GARP, and that can change. But I actually think they can blend nicely together. And to me, because I want to be a little bit more diverse, I would probably choose GARP over FANG. But if I have conviction, and we've seen mega cap tech reporting this week that we're recording this podcast, they have still done exceptionally well. So I do think that these tech companies can continue to grow stronger. And I think that whether you're looking at either concentration within mega cap tech or diverse around growth, but also having that value discipline, I both think they can make a lot of sense in this environment. It's just a matter of, do you have conviction in those particular names? So the FANG names, a lot of those names will stay sticky, whereas GARP could be a little bit of turnover and a little bit of changing. And if you want to be a little bit more diverse, GARP makes a bit more sense. If you're happy with the concentration, that's where FANG makes a lot more sense.
And that was kind of one of the things too about the retiree thing before. The comment is like, for the turnover of ETFs, so what happens inside them is something to be really mindful of if you're an accumulator and you're on a high tax rate, because you may end up with a tax bill, but a retiree doesn't have nearly the same amount of tax bills, and it's not nearly as onerous. So it can be a lot more active in the approach that you take. And we see a lot of those strategies are really effective for people looking to be more active around income or around portfolio positioning, about reducing overall volatility in a portfolio. So that's where I find it very interesting as well. Now, you and I hope, are going to catch up in a couple of weeks, and we've been challenged by everyone on YouTube to invert our question from last time, which was why choose ETFs over property in retirement. We're going to argue for the opposite side, as literally everyone in the comments on YouTube wanted us to do as well. So hopefully we'll come back and have a bit of fun. So if you're listening or watching, send us your questions, send Marc and I your questions. We'd love to hear from you, and just, throw them at us. We're big boys. We can take it, and we're looking forward to that. But this has been good. I love doing these product deep dives. A lot of people, I don't know if they're like other people. I mean, like other podcasters and that. I actually love going deep on, in particular, like ETFs. I just like it because our community are asking these questions. So I really appreciate you taking the time, Marc. But if people do want to learn more, where should they go?
I'd say our website is probably the best thing, Owen. So globalxetfs.com.au. You can find information about all of our funds, in particular with GARP. You went through live the investment case that we put out there. We've got videos as well for those who prefer video content explaining the GARP strategy. We have also done webinars around all our investing strategies. We've done some around GARP, so please sign up to our webinars. But you can always get in touch with us on socials, or if you're looking to get in touch with one of our sales team to find out more information about GARP. We think it's going to be a pretty popular product. It's only been out for a month now, just about. We've just received a recommended rating from a research house as well, which is great. So there's plenty of information, and I agree with you, Owen. I love doing these deep dives on products, because if you don't understand what the product does, you shouldn't be investing in it. So please comment about your questions around GARP investing strategy. I think it's a very interesting play, particularly in this market environment, and we're really excited to see what this product may bring us as we venture out to be one of the leading one of the leading ETF issuers here in the Australian market.
Absolutely, Marc. Well, hey, thanks for taking some time out to join me on the show.
Thanks for having me, Owen, and looking forward to the next one.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.